All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down the S&P 500. We're also going to talk about TLT and the 10-year Treasury. All right, give a nice analysis on all of those for you guys. But before we do so and hop into the analysis, there's some really important data that I want to share with you guys. We're going to cover some macro data and things like the cost of capital for the median company in our coverage has risen to 9.6% currently versus 8.5% on average during 2022. This is from Goldman Sachs. Okay. And this is just a little bit of the data that we're going to break down in today's video. It's going to be a really good one. Be sure to smash the like button, subscribe to the channel for more. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. If you're new to the channel, I started a completely free newsletter for you guys called Investment Intelligence, giving out free, valuable finance content. And I try to sprinkle in 1 or 2 free trade ideas every single week, right? This was a trade idea on Tesla. That trade idea went very well. We highlight the conditions of the trade. This is another one here on home builders, right? We talked about this one. Look at the date, August 18th, and talking about the breakdown, in the home builder sector and in the home builder ETF. And you can see that that thing has dropped 18%. It ended up dropping down 18% after that trade idea. So not all the trade ideas are long trade ideas. There's short trade ideas too, right? This is SWK, Stanley Black & Decker, going over the rising wedge, talking about where price action could come down to. That one also played out very well. So if you're fans of free valuable content and free trade ideas, you're going to want to sign up for that newsletter, all right, using the link in the description. And if you want access to all of the trade ideas, okay, you can join the Investment Intelligence Discord, right? It's very cheap. It's only a couple bucks a week, and you'll be able to get access to all of the different trade ideas, as well as a community of traders and valuable resources. Okay. If you ever enjoy these videos and you want to buy a coffee, it's basically a way to leave a tip or donation. You can do that through the Ko-Fi page. You can book a 30-minute or 1-hour session. I do these one-on-one personal sessions, all the time, and you can book a 30-minute or 1 hour, as well as request a specific YouTube video, all on the Ko-Fi page. Now, let's go ahead and get into some data. And so Russell 2000 companies carry about 4 times the amount of debt relative to their earnings compared to 1.4 times for S&P 500 companies. Now, why is this important? Why do you guys need to know, or why should you care about this? Well, a lot of these Russell 2000s are going to be your small caps, okay? And so the big mega caps, okay, things like Apple, these companies were able to refinance their debt, especially their long-term debt, okay, during the pandemic time and during that era when there were extremely low interest rates, right? So what they were able to do was lock in long-term debt at extremely low interest rates. And your small cap companies, they're in a different position, right? A lot of them are having to refinance their debt or take out debt right now. And what we've seen is a massive explosion in interest rates. So it's impacting those companies a lot. And a lot of people look at the Russell 2000 for, a gauge on how the economy is doing. And the Russell 2000, the IWM, that has been performing very poorly, right? I mean, it's not very far from the October lows of last year during that bear market. Meanwhile, the S&P 500 is up like 7-8% from those bear market lows. So it's a much different environment. And when you take a look at these small cap companies, I've discussed and disclosed the amount of bankruptcies that we're seeing, in smaller businesses continuing to rise this year. And that's where a lot of these companies are feeling the impact of these really high interest rates. Meanwhile, the bigger companies, the mega cap companies, things like Apple, right, we'll just keep using them. Not only do they have that long-term debt locked in at a very low interest rate, they also have lots of cash on their balance sheets, right? And so with the inverted yield curve, they can actually get and essentially yield farm short-term treasuries and T-bills and get paid more off of the short-term treasuries than their long-term debt, right? So they're actually making money due to the interest rate environment versus your smaller cap companies are suffering and being impacted very negatively by the interest rate environment in the yield curve, inverted yield curve. Now, economists raised the U.S. growth projections through early 2024 and trimmed recession odds to a 1-year low. So Wall Street has grown increasingly optimistic on its outlook. Again, GDP just came out All right. And, beat expectations. All right. It came in higher than people thought, than Wall Street was thinking. And, one thing that I do want to mention about that is that government spending is a portion of GDP, and the government has been spending like crazy. Okay. So, the numbers could be cooked a little bit. All right. Not saying necessarily they are, but you do want to factor in, how much money that the government has been spending. They just had the whole debt ceiling deal, and to me, that's one of the areas that's kind of a little bit misleading. Is GDP may not look as strong as it is if you were to take out government spending. All right, now these are the inflation expectations, and it looks as though the market's confidence that inflation has been beaten might be beginning to shake. Right, and we have been seeing, an uptick in inflation expectations. All right. And that's something that you want to pay attention to, right? Because if GDP is showing good, if the labor market is showing strong, right, and we're increasing jobs and adding more jobs than expected, and meanwhile, inflation expectations are going to be ticking up. Jerome Powell is really just going to keep beating the dead horse and saying and preaching that higher for longer narrative. Jerome Powell is about to speak. We're about to have the FOMC meeting very soon. Okay. And I believe that we're going to pretty much just get a hawkish pause, right? So he's going to say, we're going to pause. I don't think he's going to raise rates again, but he's going to say and mention a lot of the things that I just mentioned to you guys, right? About the labor market, about GDP, about how the economy seems to be doing fine right now to them. And so, in their eyes, they're much more worried about inflation coming back, and they'd rather just keep these interest rates high. Right now, the Taylor rule now says that the Fed should be done. That is, as long as consensus is right, that inflation slows and unemployment rises. So lots of ifs there, right? If inflation slows and if unemployment rises. Okay, we just talked about how inflation expectations are actually starting to rise, and it may seem like unemployment should be starting to rise, but we continue to see, good job numbers, and we continue to see a strong labor market. So, if we do get these two things, if inflation does slow and unemployment does rise, then they should be, pretty much permanently done with their Fed fund rate increases. And we should get that extended pause and eventually lead to a rate cut. Now, you need to be cautious of those rate cuts. Everybody wants to play the rate cut, but oftentimes they don't do those rate cuts until something is broken in the economy, and that could actually be bad news for the economy, and be reflected in the stock market. Now, the curve is now closer to disinverting than it has been in more than a year. This means that traders are more confident that there are no hikes in the near future, but also much less confident about more cuts in the long term. One thing I do want to mention about this is that the yield curve largely has been uninverting, not because so much shorter term duration, right? So your short term duration has been going lower. It's really just that a long term duration. So, your 10-year yield, your 20-year, 30-year, those yields have been rising, right? And really been in a strong uptrend as of lately. And that's mostly what's causing the disinversion. Now, we've got 36 straight weeks of Treasury inflows. This is the longest since 2010. And, lots of people have been piling into Treasury inflows, right? To different Treasuries, right? So, for instance, TLT, okay? TLT has just been seeing a record amount of people just continuing to flood into TLT, and buy into TLT, even though it's really been going lower. Now, we're going to dive into the chart, and we could be in a bottoming process here at the moment. We'll go over the exact levels that I'm looking at really to tell, and break that down further. But people have just been, putting billions of dollars into treasuries and funds like TLT. Now, this is the biggest outflow from money market funds on record. Okay, and so what we're seeing is that people are taking their money out of these money markets, okay, and they're potentially putting it, into things like TLT, or they're putting it into the stock market, right? And so maybe they said, hey, well, we were able to, milk that yield from those money market funds, and now we're actually looking to get back into the stock market after we've gotten this recent correction of around 10% in the S&P 500. If you look at the cumulative net trading flow, hedge funds reduced net length in mega cap tech, but have been selling other US stocks at a much faster pace. So, we have the Magnificent Seven in black here, and then we have the S&P 500 excluding the Magnificent Seven. And even though that we've seen big tech drop, they've really been shorting and reducing long positions in the broader market as a whole. And ultimately, a lot of people are actually looking at tech and saying this is one of the strong areas of the market through this sell-off. Now, sector positioning has gotten broadly more bearish so far in October, with hedge funds net selling TMT, cyclicals, and defensives. Okay. So, again, you're seeing that selling in discretionary, cyclicals, defensives. That's where they're doing most of the selling versus tech. Okay. And I know it may not seem that way with a lot of these tech stocks selling off, but many people aren't paying attention to a lot of these other stocks and other sectors underneath the hood. It's been absolutely brutal in a lot of these cyclicals and defensives, which is really odd because you think when the market's selling off, it would go more defensive. But when you take a look at how XLU performs, right, utilities, staples, things like that, those things got absolutely obliterated. Now, global hedge fund flows, in terms of global hedge funds, net flows, the 4-week selling is approaching an extreme. And so this could be a potential bottoming signal, right? We talked about in a previous video this week that we were getting many bottoming signals across the market when we look underneath the hood and dive into some of the market breadth and market internals. We were expecting a bounce early this week. And so far we've been, Monday was a nice day. We got a nice bounce. A lot of people may have been caught by surprise by that. But if you're in the Discord, we were pretty much anticipating that over the weekend, after we posted the analysis on Friday. Now, hedge fund short flows, single stock short flow make up about 75% of all U.S. shorting activity since the start of August and is at a year-to-date high. So this is single stock. So let's say you want to just short discretionaries, right? Well, the two biggest stocks in the XLY is going to be Tesla and Amazon. And so rather than people shorting the XLY index or ETF, what they're doing is they're going and shorting the individual stocks. So they're shorting the individual names such as Tesla or Amazon, right? Just to kind of break that down for you guys. When you take a look at their shorts, right, the hedge fund short additions are slowing from a peak pace, and gross flows have tended to fall from elevated levels as markets rebounded and vice versa. So we're seeing basically, a slowing in the shorting, okay? That could end up leading to shorts being covered, which could cause a little bit of a short-term squeeze and further extend a potential bounce in the market. Now, when you look at hedge funds versus staples, consumer staples is among the most net sold sectors in October, driven by short sales outpacing long buys 2-1. Okay. And I just brought up to you guys staples, how, you're seeing these defensive sectors just absolutely get obliterated. And you've seen massive short selling across those sectors. Okay. Now, if you look at hedge funds versus tech, information technology is the most notionally net sold sector so far in October, driven almost entirely by long sales, which suggests degrossing behavior. Okay. So to kind of explain that to you guys, it's not so much of shorting. Okay. What we're seeing here is long sales, okay, driven almost entirely by long sales. So these were long positions that are now being sold. Remember, a lot of these stocks ran up massively heading into the year. And mutual funds, okay, their fiscal year ends in October. Okay, so what that means is that if they have any losers on their books, what they're going to do is they're going to sell those in the month of October, because that's when their fiscal year ends and that's when they can do the tax loss harvesting. Okay, and it's very common oftentimes that you'll see stocks that have been beaten down, or stocks that have not been trading well in October. They'll continue that trend because oftentimes you have these mutual funds just looking to continue to sell them to get them off the books and be able to write that off for tax loss harvesting essentially. And now this is the SPX skew. All right, it's steepened dramatically over the last few sessions, which suggests investors are paying up for downside protection. Okay, now this typically actually moves with the stock market. So as you see the skew go up, you tend to see the S&P 500 go up as well. And then as you see this go down, right, then the stock market is dropping. And so people aren't really paying up for that downside protection because the market is already dropping, and, they're kind of taking profit on those downside protection bets essentially. Now, This is one argument that it's been a weak bull market. All right, it's the most unconvincing and worst new bull market for the S&P 500 equal weight index and Russell 2000. Okay, and this is basically a chart showing 1 year after a bear market low. You know, the S&P 500 bottomed last year in October. This is the last day of October. Happy Halloween to everybody watching this video. And if you take a look, the S&P went up 20%. Then you have the equal weight went up 11%, and then you have small caps went up only 5%. So remember, I mentioned earlier in the beginning of the video, about the Russell 2000 and those small cap stocks and how they're very near their October lows of last year of the bear market low. And this is kind of a chart that really just shows you guys. All right. Now, this is not year to date performance. Remember, this is the performance from the bear market low, at the bear market low. Okay. And you take a look at in comparison to many of the other times, and you can see that this is a weak bull market and has a lot of people saying that really this is a bull market head fake and that potentially we could be still in the bear market and people just don't know it. Now, here's our TLT chart. Okay. So we've got some bullish divergence right now causing the initial bounce in TLT. I highlighted this bullish divergence in the Discord for members on the last TLT analysis. If you're not familiar with bullish divergence, take a look how we're making lower lows and we're making higher lows here on the RSI. This is an indicator we could see some bullish activity. All right. And sure enough, we've gotten a little bit of a bounce, but I want people to be cautious. Okay. For me, ultimately, I think TLT could be in the bottoming process, but we don't know if the bottom is in right now. All right. One factor that you have to keep in mind, besides all of the major news that you're going to hear and see and pay attention to, really the biggest factor in the bond market is simply supply and demand. Okay. That's what moves markets. And what you have to realize is that right now and over the past year, over $1 trillion has been, flooded into the treasury markets. Okay. And so what's that doing? That's massively increasing the supply. Well, we know that there's lots of demand from investors for bonds, right? We're seeing billions of dollars flow in, and I showed you guys a chart about that. So, your retail investor, even hedge funds and things, they are buying bonds. But is that trillions of dollars worth, right? I mean, the three biggest buyers of U.S. Treasuries have been the Fed, China, and Japan. Well, the Fed is out of the picture now. Okay, they're doing quantitative tightening, not quantitative easing, and buying U.S. Treasuries. Then you have China and Japan both selling U.S. Treasuries and becoming net sellers of U.S. Treasuries versus net buyers. So, your three biggest aspects of demand and drivers of demand for U.S. Treasuries are no longer present in the market. So that's really one of the main factors that we've seen TLT continue to drop, is because of that massive supply issue. So that's something that you guys just want to be aware of and take into consideration before you try to call the bottom each time TLT makes a new low, right? When stocks are continuing to make new lows and 52-week lows, that's the trend until the trend changes, right? And we have not changed the trend where we're continuing to put in higher lows now and higher highs. Rather, we just continue making lower highs, lower highs, lower highs, lower lows, lower lows, lower lows, lower lows. So we really need to start making some higher lows here and some higher highs. And ultimately, if we're below 89.21, I think we're consolidating, right? I mean, the levels for me is the range is $80.26 up to $89.21, right? This is where I want to see us start to form the bottom, get back above 89.21 and really flip that to support from resistance, right? If we can stay above $89, then I think that that's going to be a good sign for TLT. And that's ultimately what I'm going to be looking for. For now, we're seeing a rally. We have that bullish divergence. We want to be cautious. Okay, if this bullish divergence trend line breaks right here, and this that could lead to this bear flag playing out, right? I mean, you can see we have the flag pole. We have our trading channel right here. If we break through this slight uptrend channel right here, it's very possible that's what takes us down to that $80.26 level and ends up, breaking through that bullish divergence. So that's what you're going to want to be cautious of and pay attention to. Okay. Now to the upside, I mean, there's plenty of gaps up to fill, right? That's what all of these blue boxes are right here. These gaps, they tend to fill about 90% of the time. Historically, the big question is when. So it may not be anytime soon. right? It may take a year, it may take a couple years for those gaps to fill, or we could see the bottom actually be in for TLT, and we could see a strong rally. But to see a strong rally in TLT, you're going to need to see a strong crash in TNX, right? In your 10-year treasury yield. Okay. And this thing has just been completely bullish, right? We've got some very clean structure here that it's following. And it appears we put in these wave 3 highs and we're starting to get a pullback. TNX has a gap down to about 4.715, and another gap right here down to about 4.4. Okay. If you're going to want to see TLT rally, you're going to want to see TNX come down and fill these gaps. Now, even if it comes all the way down to that 4.4 gap, it's still trading in this bullish channel, right? And it makes sense that we rejected the channel up here. We rejected it here. We rejected the channel here, here many times. It's very clean structure. And so if we break through here, you can see we got a strong bounce and we're rejecting so far 4.894. If we can continue to reject 4.894 and break this trend line here, come down and get the gap fill, then ultimately we want to break below 4.715 and come down to 4.4. Okay, but at the end of the day, that's still going to be in that bullish channel, in a potential area where TNX could actually rebound. Okay, if you really want to see the bond market go bullish, it's going to need to do all of the things we just described, and then actually break through that channel to the downside and test this 4.128 area. Okay, that's going to be a key area where you could potentially get a look below and fail. Okay, where essentially if we were to just, extend these trend lines out a little bit, right? And let's say we do come down breaking through here, and then we come through, retest, break down. And if we look below, okay, and fail and actually come back up within this range, this is going to be a signal, okay, that, a bearish signal for the bond market, okay? Being that it wasn't able to get a breakdown retest and push lower and break through 4.128, but rather it came down into that area and came back up within range. That's going to be a bullish signal for the TNX and ultimately a bearish signal for the TLT. So keep that stuff in mind. These are really some of the main things that I'm looking at when it comes to the market. Hopefully you guys enjoyed today's video. If you did, smash that like button, subscribe to the channel for more. Okay. And don't forget to sign up for the newsletter. All right. Sign up for the Discord if you want access to all of the different trade ideas. And hit me up on the Ko-Fi page if you guys ever want to book a one-on-one session or request, a specific YouTube video, anything like that.